we are going to start with job costing. So job costing, guys, is used by organizations that make unique products according to customer specification. So all products are different, all products are unique, they are made according to customer specification. So because of the fact that they are all different and they're all unique, they all have different costs. So we cost all of these jobs separately. We calculate the cost of each job separately. So you guys can see below, I've given you the general ledger and the cost ledger. This cost ledger over here, this is our subsidiary ledger. And you can see in this cost ledger, we have a separate subsidiary ledger for each job. Because of the fact that I said to you, each job is unique and each job is going to be costed separately. So because of that, I have a separate account in my cost ledger for each job. For each job, I'm going to include my material, my direct labor, and my overhead costs. And I'm going to cost each of these jobs separately. But what's important to note is this is my subsidiary ledger, and everything that is sitting in my subsidiary ledger needs to tie back into my general ledger. So you'll see that actually this work in process control account, this is my general ledger account which has a control total in it. And the detail behind this sits in my cost ledger. So I can see when I issued raw materials into production, what is my journal entry when I issue raw materials into production? I debit work in process and I credit my raw material. So that's what I'm doing over here in this journal entry. In my general ledger account, I issue material into production. So I debit work in process and I credit my material account. Take it out of material, take it to work in process. However, work in process is a control total. I want to know the detail. I want to know what portion of this cost relates to each job. If I want to know the detail, I go into my subsidiary ledger, and in the subsidiary ledger, I can see what that 800 Rand is made up of. That 800 Rand of material, 100 Rand was issued to job 1, 300 Rand was issued to job 2, and 400 Rand was issued to job 3. So I can see the detail when I look at my cost ledger. Everything is costed separately, or all the jobs are costed separately, but I've got a control total over there in my general ledger. So this next paragraph just deals with what I've discussed with you now. So all of our costs, our direct material costs, our direct labor, and our overhead costs are accumulated separately for each job. So we saw that below. Separately for each job, we accumulate those costs. We cost each job separately. We open a specific general ledger account for each job, against which the costs of that job are debited. So here we have a separate ledger account for each job, and we debit the ledger account with all of the costs for that job. The ledger accounts for the different jobs are grouped by means of a central control account. So the central control account is our work in process account. So in the general ledger, we saw that was where our control total was sitting. And work in process is a summary of everything that is recorded in the separate job accounts in the cost ledger. So that's exactly what we saw. The work in process gives us the total or the summary of 800 Rand, and the cost ledger gives us the detail. So that's important to note about job costing. All you need to know with job costing is we are dealing with a company that makes unique products, different products according to customer specification. So because all of the products are so different, we cost each job separately. On the other hand, if we move on to the next page, process costing is exactly the opposite of job costing. Job costing was unique products made according to customer specification. When we look at process costing, we are now looking at products that are very similar. So this normally happens in the following industries, where we have chemical processing, oil refining, food processing, a paint manufacturer, brewing, and paper manufacturers. Because all of their products are so similar, companies in these industries normally use process costing. And with process costing, what we're going to do is we are not going to cost each job separately. We're going to work out an average cost per unit. Okay, don't cost each unit separately. And this should make sense. Why are we not costing each one separately? Because all of the products are similar, it means that they consume the same amount of costs and overheads, direct costs and overheads. So it's unnecessary to cost all of these products individually. For example, if we have a company that makes paint, 1 liter of paint is identical to another liter of paint. So it's completely pointless to try and cost each liter of paint separately as we would do in a job costing system. So job costing costs all of the jobs separately. Process costing, we are not going to cost all of the jobs separately because they are all the same. Each unit is exactly the same as the next. So job costing would be pointless. Instead, what are we going to do with process costing? We are going to calculate the average cost per unit. And how do we do that? We just take the total cost for the period and we divide it by the number of units produced in the period. And we work out an average cost. So let's look at an example of how you would get that average cost. The following information relates to Wacky Juices Pty Limited. I've given you the material, labor, and overhead costs. So we have a total manufacturing cost of 760,000 Rand. And during the period, they expect to produce 50,000 units. So I said to you, all we're going to do with process costing is work out an average cost per unit. So process costing is the easiest section you're ever going to see in management accounting because look, that's how we cost our products. Right. And you get an average cost per unit. Okay, but you are now at CTA and you have done process costing before in undergrad and you had to understand process costing in order to pass your undergrad papers. And you will definitely remember that process costing is not as simple as just doing that. Why is process costing not as simple as doing that? We have certain situations that arise that make our calculations a lot more complex. What causes the calculation to be more complex? Number one, the fact that we have opening work in process. What is opening work in process? Remember, opening work in process means I started production on these units in the previous period. However, I didn't complete them. So in the current period, I'm still going to have to do a portion of the work so that I can then complete these units. So having opening work in process complicates my calculation, and that's why process costing isn't as simple as just taking the total cost dividing by the total units. What else complicates our calculations? The fact that we have closing work in process. Now you must understand the differences between opening and closing work in process. We've discussed opening work in process. Closing work in process means that I started the units in the current period, but I didn't finish them. So the units are incomplete at the end of the current period. I started production, but I didn't complete them. So in the future, I'm going to have to still do more work on these units in order to fully complete them. In the next financial year, I will have to then complete these units. And the last thing that makes process costing more complicated is the fact that we often have losses in our production process. And when we have losses in the production process, these are either classified as normal losses or abnormal losses. So that is why, you know, when you've done process costing before in the past, our calculation is not that simple, because these three things over here make our calculation more complex. So how do we deal with these three issues? Okay, firstly, how we deal with the first two issues, the fact that we have opening and closing work in process. How do we deal with the issue of work in process? We deal with this by calculating equivalent units. And this is extremely simple, very, very simple. Look at our example. At the end of December 20X5, there are 100 incomplete units that are sitting in work in process. So is this opening or closing work in process? This is going to be closing work in process. I started production on these units, and at the end of December 20X5, there's 100 incomplete units sitting in work in process. Okay, then these units are expected to be 60% complete. So all we need to do is we need to calculate the equivalent units. How do we calculate the equivalent units? All we do is we say there's 100 units sitting in closing work in process. They're 60% complete, which gives me 60 equivalent units. Now, please note, it's very important to understand over here. I'm not telling you that we have 60 units sitting in closing work in process. We do not have 60 units sitting in closing work in process. We have 100 units sitting there that are 60% complete. But it's not possible to do our calculation with 100 units that are 60% complete. We can't work with that. What we can work with is we take those units and we convert it into equivalent units, something that we can work with. And when we do all of our calculations, we do our calculations based on the fact that we have 60 equivalent units sitting in closing work in process at the end of the period. So guys, that is how we deal with the first two problems. Okay, the fact that we could have opening and closing work in process. How do we deal with the problem of losses in the production process? Now, before we look at a calculation over here, you do need to be able to distinguish between what is a normal loss and what is an abnormal loss. Now, normal losses are inherent to the production process, okay, meaning that they are expected to occur under efficient operating conditions. We know that it's going to happen. It's just a normal part of the production process. Normal part of the production process, so it is a normal loss. It can't be controlled, it can't be avoided, it's something that will always happen, okay, because it is inherent to the production process. For example, if we are a company that manufactures paint, and during the manufacturing process, we know that a certain percentage of the paint evaporates. That is going to be referred to as a normal loss. It is a normal part of the production process. It's inherent to the production process. It doesn't mean we did anything wrong. It's what happens under efficient operating conditions. It's not controllable. It's uncontrollable. It's unavoidable. It will happen. Okay, it's a normal part of the production process, the paint evaporating. On the other hand, guys, if we look at abnormal losses are not inherent to the production process. They are not expected to occur under efficient operating conditions. So these are controllable or avoidable because it should not have happened. Okay, so by training people and by making sure production processes run the way they're supposed to work, we can then avoid abnormal losses. Okay, so for example, with our paint example, this is now someone knocks over a tin of paint. That is not inherent to the production process. It should not have happened. You should not have knocked over a tin of paint. It is controllable. You make sure you train people so that they don't do these kind of things, which means it's classified as an abnormal loss. It is not a normal part of the production process. Now, why is it so important that you understand the difference between a normal and an abnormal loss? For our accounting treatment. Normal losses get included in the value of our inventory. Okay, whereas abnormal losses are written off as an expense in the period that they are incurred. And this is what we are told to do, guys, in terms of IAS 2. IAS 2 says wherever you have a normal loss in your production process, you include the normal loss in the value of your inventory. However, where you have abnormal losses in your production process, that does not affect the value of inventory. Abnormal losses are expensed in the period incurred. So let's look at a couple of number crunch examples over here. Example 3. Assume the cost of input of 500 units is 7,500 Rand. Okay, so this is my production process over here. What am I inputting into my production process? 500 units. And the cost of that input is 7,500 Rand. We'll come back to the cost. Normal losses are 10% of our input. So that's our normal loss. So the normal loss that we are going to have over here, if it's 10% of the units that are put into production, the normal loss is going to be 50 units. I'm then told that my output at the end of the process is 410 units. So I'm only getting 410 units out the other side. So I'm putting 500 units into production. 50 of those units are lost, and that is a normal loss, which means my abnormal loss must be 40 units because I'm only getting out of production the other side an output of 410 units. All right, so at the outset, if we try and calculate the cost per unit, we know that our total cost is 7,500 Rand, and we're putting 500 units into production. So it looks like we have a cost of 15 Rand per unit when we try and value our inventory. We'll value it at 15 Rand per unit. Okay, initially that's what it looks like. However, what we've been told in IAS 2 is our normal losses should be taken into account in the value of our inventory. So what we need to do is we need to say, what is the normal loss? The normal loss is 10%, which means it's going to be 50 units, okay? Which means after taking the normal loss into account, I'm sitting on 450 units. So that means when I calculate this unit price over here, I shouldn't say 7,500 divided by 500 units. I should say 7,500 divided by 450 units because I need to take the normal loss into account when I value my inventory. Okay, so normal losses are taken into account when we work out our inventory cost per unit, which means because of the fact that I have a loss in my production process, my inventory unit cost is not 15 Rand, it's higher. My inventory has to be recognized at a higher amount because the inventory cost per unit must take normal losses into account. Okay, and then what we can do, guys, is we know we have a cost of 7,500 Rand. So let's allocate that cost. First, what should be sitting in completed units or finished goods? So this is my inventory. My finished goods inventory, my completed units. How many units did I complete in the period? 410 units. What should I value those inventory units at? 16 Rand 67 because normal losses must be taken into account. Work out the value of your finished goods. That goes to inventory, which remember is treated as an asset. Then we look at our abnormal loss. How many units was the abnormal loss? 40 units. So my abnormal loss is 40 units multiplied by that same inventory cost per unit, and that is my abnormal loss. And remember, abnormal losses do not affect the value of my inventory. My abnormal loss is going to be expensed in the period incurred. All right, so not too difficult. I'm just going to make it slightly more difficult over here. In example 4, we're dealing with exactly the same example, but now I want you to assume that those units that are lost have a scrap value. Okay, so let's assume that all units that are lost during the production process have a scrap value of 10 Rand per unit. So guys, from the previous example, what was my normal loss? My normal loss was 50 units. What was my abnormal loss? 40 units. Now what we're saying is those units that are lost, we're not just going to scrap them, we can actually get something. So we're obviously not talking about evaporated paint over here because you wouldn't be able to sell that as scrap. But now maybe we have a company that's involved in carpentry and any offcuts of wood that are lost in the production process, maybe they can be sold as scrap. Okay, so now because these units can be sold for 10 Rand each, we actually have a bit of income. The 50 units, the normal loss, we can make 500 Rand off of that. And from my abnormal loss, I can make 400 Rand. So when these units are sold as scrap, the company makes 900 Rand. Okay, so how do we deal with a situation where these units now have a scrap value? Let's see how it changes my calculation. First, how did I work out my inventory cost per unit in the last example? Remember, I had to take the normal loss into account when I worked out the inventory cost per unit. So I took my total cost of 7,500 Rand, took this total cost here of 7,500 Rand, and I divided by 450 units because I must take the normal loss into account. That's how I got my inventory value. Okay. However, my cost is now no longer 7,500 Rand because these units are sold for 10 Rand each. Remember, the normal loss is taken into account when we value our inventory. The abnormal loss is not. Ignore the abnormal loss for now. Only look at the normal loss. These 50 units that are lost can be sold for 10 Rand each, which gives the company 500 Rand for the normal loss. Which means, guys, my costs are no longer 7,500 Rand because the 50 units that I can sell for 10 Rand each gives me income of 500 Rand, which means my cost is now only 7,000 Rand. So the cost of 7,000 Rand divided by the same 450 units, which must take the normal loss into account, gives me an inventory cost per unit of 15 Rand 60. So obviously in the last example, my inventory cost per unit was 16 Rand 67. It was higher. Now my inventory cost per unit is going to be lower because of the fact that the units have been sold for a scrap value. The company had some income from those units, which reduced the cost. All right. However, when we worked out this inventory cost per unit, we only took the normal loss into account. So we used 450 units because we take the normal loss into account. And when we worked out this cost, we said 7,500, which was my total cost. And I subtracted the income that I was going to get from the normal loss. From selling the units from my normal loss, I would make 500 Rand income. I did not take the abnormal loss into account when I calculated my inventory value, which means now for my abnormal loss, how are we going to do the calculation for the abnormal loss? Now we take the 40 units which were lost and we value them at 15 Rand 56, the same 15 Rand 56. For my completed units, what do? I take the 410 completed units and I value them at 15 Rand 56. So this is my finished goods inventory or an asset. And my abnormal loss over here is going to be expensed. So I've got an expense there of 622 Rand. The abnormal loss does not affect the value of inventory at all. It's treated as an expense in the period. Okay. However, we haven't taken into account anywhere the fact that these 40 units can be sold and it will generate income of 400 Rand for the company. We now need to take that into account. So this is income that the company will make when they sell those units. So what we do is, this is an expense of 622 Rand. This is income of 400 Rand, which means the net effect is I'm sitting with an expense of 222 Rand. So what do I do with the abnormal loss? When I'm calculating my abnormal loss, I take the number of units, I multiply it by the inventory cost per unit. And then what do? If those units can be sold for a scrap value, you need to take the income that you get from selling those units as scrap and you need to reduce your abnormal loss by that income that you get. Because look at the proof below. What was the total cost of the company? 7,500 Rand. However, they could make 900 Rand from the sale of these scrap units, which means the net effect is we are sitting with a cost of 6,600 Rand. And that ties in over there apart from a very small rounding difference. Then lastly, we just need to look at abnormal gains. So first, you just need to understand what a gain is. It doesn't mean that I put 500 units into the production process and I get 550 units out. That's not possible. All an abnormal gain is it means that the normal loss was less than what we expected it to be. Okay, so let's look at the example so I can show you how we deal with abnormal gains. So let's assume a gain. What are we inputting into our production process? 500 units. And the cost of that is 7,500 Rand. Normal losses are 10%. So normal losses is going to be 50 units. Then I'm told output is expected to be 450. Okay, so that makes sense. If I'm putting in 500 units, 10% of that is a normal loss, then my output is expected to be 450. Makes sense. Again, assuming still that these normal units that are lost have a scrap value of 10 Rand per unit, this should be offset against the unit cost as follows. So look how we calculate our unit cost. So we say we've got a cost of 7,500 Rand. Okay. However, these 50 units we think are going to be sold for 10 Rand each, which generates 500 Rand income for the company. So that must be taken into account because it means I'm sitting with a cost here of only 7,000 Rand instead of 7,500 Rand, because the normal loss must be taken into account when I calculate the value of my inventory. Then when I divide, I don't divide by 500 units, I divide by 450 units, again, because the normal loss must be taken into account. So we work out our inventory cost per unit. And if you refer above to the previous example, it's exactly the same inventory cost per unit that we calculated previously, because it's the same scenario. We've got 50 units, which are the normal loss. Those units have a scrap value of 10 Rand, and it gives us an inventory cost per unit of 15.56 Rand. All right. But now we have an abnormal gain. And remember I said to you, an abnormal gain just means that the normal loss is less than what it's expected to be. So in this example, what is my normal loss expected to be? It's expected to be 50 units. Now we're told only 20 units were lost instead of 50. So in other words, my actual output was 480 units. So I'm now getting 480 units out of my production process because only 20 units were lost. Okay, so my normal loss was not 50 units, my normal loss was actually only 20 units. So guys, that is an abnormal gain because my normal loss is less than what I expected it to be. I expected it to be 50 units, but it was only 20 units. I'm dealing with an abnormal gain. What's important to note is we do not adjust the value of inventory for any abnormal gains. So the value of inventory is going to stay at 15.56 Rand. Do not adjust the value of inventory. So look what happens now when we allocate this cost. What goes to my finished goods or my completed goods? I've got 480 units. I don't adjust the value of my inventory. I value them at 15.56 Rand each. So that is my inventory. My finished goods inventory, which is sitting as an asset on my statement of financial position. Then what do? I take into account the fact that I have an abnormal gain. Okay. Why am I subtracting the abnormal gain? Because guys, this is a cost and the abnormal gain is an income. Okay, so I'm reducing my cost by the abnormal gain that I receive. How do I work out what that abnormal gain is? Very simple. I expected my normal losses to be 50 units. What was my normal loss? It was actually 20 units. So I have an abnormal gain of 30 units. And very simply, you take those 30 units, you multiply it by your inventory cost per unit. We've got a gain of 467 Rand. However, there's still one more thing we need to take into account in our calculation. I need to take into account the fact that when I calculated above this inventory cost per unit, when I worked out this inventory cost per unit over here, this was based on the assumption that I was going to sell 50 units at 10 Rand each. I can't sell 50 units at 10 Rand each because my normal loss was not 50 units. My normal loss is only 20 units. So the problem is here, I've actually made this inventory cost too low because I've taken 500 Rand into account, which I'm not going to get. I'm not going to be able to sell 50 units at 10 Rand each. I'm only able to sell 20 units at 10 Rand each. So we've got an opportunity cost. These lost sales that I'm adding over here, this is an opportunity cost. So it should make sense why I'm adding it. When we have costs, we add all of our costs together. And when we have income, we reduce the income, or we reduce the cost by that income amount. What are the units I'm losing out on? I'm losing out on selling 30 units at 10 Rand each. So I'm sacrificing 300 Rand of my sales. If my normal loss was 50 units, I would have made 500 Rand on selling those units. My normal loss was actually only 20 units, which means I could only make 200 Rand. How much money am I losing out on? I'm losing out on 300 Rand. Okay, so guys, this is a net effect that will go to profit and loss. So your abnormal gain goes to profit and loss, It does not affect the value of inventory. We didn't take it into account. We didn't adjust the value of inventory. We kept the value of inventory the same as the last example where we didn't have an abnormal gain. So inventory is not affected by abnormal gains. Abnormal gains are taken directly to profit and loss. But be careful, when you calculate the gain, remember you also have an opportunity cost that you need to consider. Okay, and you can look at the proof below. You can see everything does tie in. We have a total cost of 7,500 Rand, less the 200 Rand that we make on the sale of these 20 units, means I have a cost of 7,300 Rand. How is the 7,300 split? That's what goes to inventory. That's what goes to profit and loss.